From DLA Piper, this is the Beyond the Curve podcast. In this episode, DLA Piper's Steve Dixon and Evan Migdail discuss the reconciliation process and the new federal budget bill, examining key tax proposals and their potential effects on multinational corporations.
Welcome to Beyond the Curve. My name is Steve Dixon, and I'm a tax controversy partner at DLA Piper, based in the DC office. I'm joined today by Evan Migdail, who's also a tax partner based in DC. Evan's practice focuses on representing taxpayers with respect to tax legislation. Evan had a long career on the Hill and has been representing taxpayers before Congress and before the IRS and the Treasury Department for many years. Thanks for taking time today to speak with us, Evan. I know it's a busy time given the tumult over the reconciliation bill.
I'm happy to be here, and thank you very much for having me.
We are recording this on July 2nd, so by the time this episode is out, this reconciliation bill might be signed into law, or it might not. What we wanted to do today was focus on some learning about what's happened so far, because there are some things that are now in the past with respect to this reconciliation bill, and we want to talk about some of the matters of process and tax policy as they interest our clients. One thing that would be of particular interest to our client base is the proposed Section 899. So maybe we could talk a little bit about what that section was and why it got pushed out of the reconciliation bill.
Section 899 was intended as a way to negotiate with foreign countries to change their tax laws to the extent that those laws were discriminatory against American companies or American individuals. It was a new section in the code, and its purpose was to basically increase the taxes for foreigners or foreign companies from countries that discriminated against American taxpayers. It was put there in the House of Representatives, and during consideration in the Senate, the United States Treasury Department reached an agreement with the OECD to reduce the exposure of the United States to Pillar 2, to taxes imposed by the OECD, that would take the position that if an American company made profits above a certain level, those excess profits would go to a foreign country's Treasury Department. The current administration opposed that very deeply. The prior administration was also trying to negotiate some kind of accommodation with the OECD. And when the Treasury Secretary announced that such an accommodation had been reached, he said that one of the reasons for the agreement was an agreement by the United States to pull Section 899 out of the bill if an agreement was reached. So a few days ago, the Treasury Secretary actually asked the Congress to remove the provision, and it was dropped. I might say Section 899 was very controversial during the entire period of the consideration of the reconciliation bill. At one point, some Republican senators opposed it, but said that they would only support it if it was delayed for a year to give the United States more time to negotiate with foreign countries and with the OECD. The change in the 1 year altered the revenue raised by the provision by more than half. Originally, it was going to raise $116 billion, and in the end, it only raised $52 billion. And then finally, it was pulled from the bill and will not become law.
This is, I think, a somewhat unconventional approach to tax legislation, to treat it as a tool for leverage in negotiating with other countries and the OECD. Is there any precedent for anything like this in the past?
There really isn't. Normally, trade negotiations were kept out of the discussion of tax policy, but in this administration, it's a little bit different because this administration talks about tariff policy and tax policy being related. So remember, this president came to office talking a good deal about trade, and so using tax tools as well as trade tools to get agreements with foreign countries has become normalized in this administration. I expect we will see more of it. In fact, I think that if there are not a number of trade agreements reached in the next few months, you could easily see the administration going back to some kind of 899 mechanism again for the same reason, to try and push foreign governments to make certain agreements with the United States.
And that was, if not expressly stated, at least implied that Section 899 was meant to incentivize taxpayers to lobby foreign governments on behalf of the U.S., effectively.
Correct. And it was also one of the controversies over 899 because the Joint Committee on Taxation has to score how much is raised or lost with a tax provision. And there were questions about how much 899 actually would raise. because if it resulted in changes in foreign tax laws or changes in the OECD generally, then you wouldn't raise as much as it would have raised. And so opponents of 899 argued to the Joint Committee on Taxation that it really didn't raise anything. It was way too speculative to determine whether it really raised 112 billion or 52 billion. In the end, an agreement was reached, and the decision was that it couldn't be used at all. And frankly, once the agreement was reached, my immediate reaction was it couldn't raise anything because it had accomplished its goal without being in the bill. And it would have been challenged then as not having any revenue impact.
Right. And it puts the administration in an odd posture in the sense that including 899 as a revenue raiser is desirable in terms of scoring the bill. But at the same time, if 899 actually served its purpose, it raises no revenue at all.
That's correct. By the way, under the scoring system of the Congress, there's no accountability if the score is wrong. So if you put something in a tax bill that's supposed to raise $52 billion and you discover a year or two later that it didn't raise anywhere near that much, there's no accountability. The only impact is that the national deficit goes up because you didn't raise as much money as you thought. But the problem was the agreement between Treasury and the OECD was reached before the bill was enacted, and therefore Joint Committee probably would have rescored it as raising much less or no revenue at all. So it had to come out.
And I think what we expect is to do some more podcast episodes in the future where we talk a little bit about what this means for the OECD and what this means for the US in its negotiations about UTPR and
Correct.
digital services taxes and the like. So, Evan, one of the interesting parts about this reconciliation process is that some of the more arcane features of the Senate and the Senate's rules have really come into play and played a large part. So could you begin by talking a little bit about what the Byrd Rule is, why that's in place?
The Byrd Rule was created as part of the Budget Act of 1974 by Senator Robert Byrd, who was majority leader and an expert in Senate procedure. Most bills in the Senate require 60 votes to proceed, but the decision was made that a special privilege would be given to the Senate to allow a bill to advance with only 50 votes, because the purpose was to either raise taxes or reduce spending in order to meet or to reduce the budget deficit, which at the time was about $50 billion a year. As part of that privilege, everything in a reconciliation bill has to have a budgetary effect within the 10-year budget window. Nothing in a reconciliation bill can touch Social Security or Social Security revenues. And in addition, if the dominant feature of a provision in reconciliation is really policy unrelated to the budget, it can be stricken from the bill, and the person who makes the decision about whether those rules are being met is the Senate parliamentarian.
So it would be good to go back to the days when the budget deficit was only $50 billion. That would be serendipitous, but not our charge. So tell us about what the Senate parliamentarian is doing in terms of enforcing the Byrd Rule.
What she does is to go through every single word in the bill, every line, to determine whether it meets those rules that I just described. If a provision does not meet those rules, she will take the position that the bill has lost its 50-vote majority privilege and must now be passed under 60 votes. In the case of this bill, for example, there are 53 Republicans in the Senate. None of the Democrats were willing to vote for the bill. So the loss of the 50-seat simple majority privilege would have doomed the bill. So what she does is she goes through it. She calls this the Byrd bath, and she goes through every single provision, and she creates a list of what can't be in there, and they have to remove those provisions. Or, by the way, they can take a vote to waive the Budget Act, keep the provision in, but catch-all, that requires 60 votes.
Right. And this is the predominant reason why almost all of the tax legislation that we've seen for quite some time has happened through the reconciliation process, right?
That's correct, because it's easier to pass on a purely partisan basis, and Congress has become a more partisan institution because of it.
When was the last time that we passed a tax bill that didn't go through reconciliation?
Probably the largest single tax bill that was passed under regular order in recent times was the 1986 Tax Reform Act. That was a regular order bill, and you had bipartisan agreement on it, and so it went through regular order. We haven't seen that in a very long time.
So the parliamentarian's taken on a more prominent role than usual this time around with this reconciliation bill. What are some of the other things that the parliamentarian has done with respect to this reconciliation bill?
Well, for example, there were Medicaid provisions that dealt with whether certain foreign people or people who were undocumented in the United States could qualify for Medicaid. She determined that was a policy determination that should be made under regular order and struck that. There was a provision, for example, that imposed a tax on foreign funders of litigation in the United States. And it raised about $2.5 billion. But again, the parliamentarian determined that that provision really had to do with judicial policy and should have been taken up by the Judiciary Committee and brought up under regular order. So there were a number of these things where she determined they shouldn't be in there. Interestingly enough, the issue is not whether it costs something or raises something. Some of these provisions raise $6, $7, or $8 billion. But if she determines that the real reason for it is not budget policy, but really some kind of judicial, immigration, environmental policy, then she can strike it out.
Putting yourself in the parliamentarian shoes for a second, how does she go about making those decisions? And is there any sort of collective wisdom that's handed down from parliamentarian to parliamentarian that provides any guidance as to how to make these calls?
I worked in the Senate, and the Senate is filled with unwritten rules and rules of precedent for what people did before. So you're correct in asking that question. You look to see what other parliamentarians have done. And the Byrd Rule is a little obtuse. There's not a lot of detail on it. There isn't exactly a guidebook. But she goes by a determination, bit by bit, provision by provision, about what it really means and what it really does, and makes that determination. There is no real appeal of what the parliamentarian does. It's not done in committee. She does have a staff, and they look at everything. Last few days, they've been extremely busy, as you can imagine. She also doesn't publish her decisions. So she just simply will say, Provision 70606 violates the Byrd Rule, and if you leave it in, you lose your majority privilege. That's how it works. The only appeal is really the Senate can overrule the parliamentarian. There were calls by some members to do it in this bill. The majority leader, Senator Thune, decided not to do that because he felt that these rules should apply to both parties. And if you start creating a precedent that you overrule the parliamentarian, then you no longer have a 60-vote margin for anything in the Senate, and everything the Senate will ever do will be in a reconciliation bill. That was a precedent he didn't want to set.
Because we know this is a question that will crop up. How does the Senate parliamentarian get appointed in the first instance?
She's appointed by the majority leader, usually from someone who really knows Senate procedures. Usually it's someone who's been in the Senate for a long time. And one thing about the parliamentarian is, while people may have complained about what she did on this bill, when the Affordable Care Act came up, when other bills have come up, which the other party has advanced, she's used exactly the same level of scrutiny. You have to be very careful to treat both parties exactly the same way and for your rulings to be very pure and very common to both parties and what they do. You can't be partisan in that job.
Rigorous, in other words.
Rigorous and completely nonpartisan.
Just transitioning for a second, one of the things you mentioned there was how some of these provisions got scored. And I think that there has been a borderline sea change in how to score this particular bill. Could you explain a little bit about what that change is?
It's an issue that's being debated in the House of Representatives today as they consider the bill, both by Democrats and some Republicans who don't like the change. The Senate Republicans decided to use something called current policy baseline. Let me compare that to what came before. What came before was the idea that, let's say, all of the Trump tax cuts end at the end of this year. They will be extended, but they otherwise would have ended.
And just to be clear, we're referring now to the TCJA from 2017.
Yeah, all of those cuts. So the baseline of the United States budget on January 1, 2026 assumes that more revenue will come in because tax rates went up. That's called a current law baseline, and it assumes the law is going to change as it would have on January 1, 2026. However, Senator Graham, who's the chairman of the Budget Committee, and the majority leader and a majority of the Republicans in the Senate took the position that we know that we're going to extend current policy. That's what we're going to do. It's built into the system. So really, we should use a current policy baseline based on what we really want to do, not what the budget actually looks like. So they took the position that extending all of those tax rates that otherwise would have expired at the end of December didn't cost anything, and that it was basically a continuation of current policy. Now, that meant that for scoring purposes for this bill, they did not score that as a loss in revenue. Assuming that there is not another way to make up the revenues, it could have a negative impact on the deficit next year and in years thereafter. We'll have to see.
And so who within the process decides the ultimate scoring of the bill?
Well, that determination was made by the chairman of the Budget Committee, Senator Graham, and the Senate went along with it. The Democrats didn't like it, but the Senate went along with it. As far as scoring particular provisions, it's done by the Joint Committee on Taxation, which scores provision by provision and what they believe it's costed. And in this case, by the way, they put out two scores. They put out a current law baseline and a current policy baseline so you could see the difference.
So the Joint Committee produced these sort of side-by-side
Correct.
figures.
Correct.
Because then doing anything else, I presume, would be borderline partisan.
Right. And the numbers change because if you look at a current law baseline, JCT, I think, concluded that the bill actually loses about $3.5 trillion. But if you look at a current policy baseline, JCT concluded, assuming that the extension of the tax cuts didn't have a revenue impact, at least for their purposes, it only lost about $400 billion. It was a very big difference.
Right. Now we'll let you do just a little bit of prognosticating. So again, we're here on July 2nd. The Senate passed their version of the bill yesterday, and the ball is now back in the House. What should we look for? What are the sort of big decision points here?
The Republican margin in the House is very tight. I believe they can't lose more than 4 votes. And the Democrats have already said, no, the Democrats are going to vote for the bill. So they have to keep everybody together. They can lose a couple, and they will probably lose 2 that I can think of. Chances are they're going to pass the bill. And the reason is they're in enormous pressure from the White House and from their leadership. So you have members who are complaining. They're saying they don't like the current policy baseline. It'll raise the deficit. They're saying that the current policy baseline actually does not conform to what was agreed to in the budget resolution, which began the process. And you'll be hearing this for a number of hours. But they're also hearing from their leadership and from the White House that if you don't pass this bill, it looks like a colossal failure and we'll all be blamed for it. So the better thing to do right now is pass the bill and then look for some other way to deal with the things that you're complaining about. And so, for example, a little while ago, the speaker said that he understood that not enough was cut in the bill, so he was interested potentially in another reconciliation bill, which they have the right to do for the next fiscal year, which starts October 1st, and we can look at entitlement reform and cutting more programs. So my guess is at the end of the day, people will complain, but the greater good they will feel is to come up with the necessary votes to pass the bill. It probably passes tonight. One of the things that's delaying the vote is that there's bad weather in parts of the country and members had gone home. They need to fly back to Washington, and they're not going to take the vote until the Republicans feel they have enough Republicans in the chamber to pass it. Could be very late tonight.
If there's Republican opposition at this point, it's mostly from deficit hawks.
Mostly from the deficit hawks who feel that this was not what they were promised when the process began, but they will be made another promise that somewhere down the road, their concerns will be addressed. That probably will bring them together.
Anything else that we should look for in terms of possible changes from the House to what the Senate passed?
I don't think the House will change the bill. I think they're under pressure not to change it. Remember also, the president wants to sign the bill by July 4. That's 2 days away. If the House changes the bill, it's got to go back to the Senate. Senate has to come back to town and vote. I don't think they want to do that. And I think at the end of the day, they'll pass it. If I'm wrong, I could be accountable for it. But my guess is sometime tonight, maybe in the wee hours of the morning, they'll have the votes.
Well, thank you so much for joining us today, Evan, and taking time out of what I know is a very busy schedule, given what's happening in D.C.
Thank you for having me. I appreciate it.
I want to close today by thanking the firm for letting us do this episode of Beyond the Curve. And I want to also close by promoting our forthcoming podcast, The Tax Brief, a podcast about the tax law from the lawyers at DLA Piper. As I said at the outset, I'm Steve Dixon, a partner in DLA's Washington, D.C. office. My practice focuses on tax controversy and litigation, but the Tax Brief podcast does not. In fact, our aim with the Tax Brief is to be as expansive as the DLA tax practice and discuss issues from every area of law where our lawyers and other professionals advise clients. While we'll do our best to be topical, our real goal is to be informative, conversational, and interesting. We'll try to do more than just offer you the tax news. Instead, we hope to go one cut deeper and explore the arguments, ideas, complexities, and nuances that crop up in our diverse tax practice. And as the name suggests, our aim with the Tax Brief is to be, well, brief. We hope to offer bite-sized episodes that cover enough ground to be informative, but short enough that you won't have to split between your morning and evening commutes.
Thank you for listening to DLA Piper's Beyond the Curve podcast. All information, content, and materials contained in this podcast are for general informational purposes only. This podcast is intended to be a general overview of the subjects discussed and does not create a lawyer-client relationship. Statements and opinions are those of the individual speakers and participants and do not necessarily reflect the policies or opinions of DLA Piper LLP US. The information contained in this podcast is not and should not be used as a substitute for legal advice. No listener should act or refrain from acting with respect to any particular legal matter on the basis of this podcast without first seeking legal advice from counsel in the relevant jurisdiction. This podcast may qualify as lawyer advertising, requiring notice in some jurisdictions. Prior results do not guarantee a similar outcome. DLA Piper LLP US accepts no responsibility for any actions taken or not taken as a result of this podcast.